Live from the Subaru of Gwinnett studio at the beautiful Sonesta Gwinnett Place Atlanta Hotel, it's The Bottom Line with Jacqueline Sheldon on Business RadioX. Maximize your return on investment by reducing your tax bill. Get ready for the best tax talk you've ever had. It's The Bottom Line, presented by Bottom Line Tax Solutions. Welcome back, ladies and gentlemen. Hope everyone is still enjoying the summer. Hello, Jacqueline. How are you?
I am doing well. How about yourself, sir?
I am always fantastic. It's another day in the studio with The Bottom Line with Jacqueline Sheldon. I'm always excited.
Oh, yeah. It's always a fun day to be here.
Now, here we have a guest today.
We do have a guest today.
Are we going to leave everyone in suspense? I like when we do that.
I think you ought to introduce her.
Okay. She's over there. Don't leave yet. We haven't got to you. Come back. Come back. Ladies and gentlemen, we have with us Sandy Hill from Fairway Independent Mortgage. Hello, Sandy.
Hi, Tom.
We will be speaking with Sandy more and more as the episode goes on, or actually, I guess the second segment of the show will be all Sandy's.
Oh, boy.
Ooh, that's going to be exciting.
I'm excited.
But please chime in if Jacqueline makes a mistake. Chime in. I mean, she never does.
Never.
First for everything. I'm just saying. Jacqueline's leaving. Come back here. We're not done yet. Before we get into today's show, last month we did the show on going back to school and how that affects taxes and everything.
Right.
I was shocked at how many people came up to me asking me all these college questions, and I had no clue. I sent them to you. I hope they made them. Everyone made it to you.
Oh, yeah.
It was an insane response.
I got a few telephone calls with questions about the things that we talked about on the show last month. So
I need commission
awesome.
on those, by the way.
Okay. We'll see what we can do on that.
Yeah, close your eyes, see what you get. But today, though, the matter at hand, and one reason we have Sandy with us, tax advantages of being a landlord.
Yeah, we're going to talk about rental real estate today.
That sounds exciting. Because, you can build wealth doing that, right?
Right. Real estate can be a great vehicle to build wealth. It's also a great way to create passive income.
Now, what's passive income?
Income that you don't necessarily have to work for.
Oh.
So that can give you a passive income stream in your retirement years. It's a great way to supplement your retirement income, to have that rental income coming in. So it's a great vehicle there, not only to build wealth, but like I said, you can use it as passive income in retirement years.
Well, we all need more money, but I know what more money does.
More money does
affects taxes.
Your income taxes. I figured that's where you were going with that.
That's why we have you, right?
Right. Well, I have a lot of clients who choose to invest in real estate. Property values in our area continue to go up. So it can be a good vehicle to help build wealth. Rental property also, though, it isn't a perfect fit for everyone. There's a lot of things you kind of have to take into consideration. First of all is your financial strength. You have to keep in mind that if you have a tenant that doesn't pay their rent, or maybe you have a property that's vacant for a few months, you don't have a tenant, you still have a mortgage to pay. So, you need to keep those things in mind. Your financial stability really comes into play there. You want to make sure that you're comfortable being able to make that mortgage payment even if you don't have a tenant in the property. You also have to keep in mind those late night telephone calls, Saturday night at 9 a.m. or 9 p.m. when your tenant calls and says the air conditioner's out and can you run over here and take a look at it. There's a certain temperament you have to deal with tenants, so you kind of have to keep that in mind as well. But just from a financial standpoint, a lot of my clients find that it's advantageous, that it's a good fit for them, and in some cases there are some tax benefits of having rental property.
When you said temperament with tenants, why did everyone in the studio look at me? what the abuse? The abuse. It starts early today. But how does all that affect taxes? I mean, you're making more money. You're thinking of investing in rental real estate. What do the folks out there need to know? How's that going to bludgeon their tax whatever I'm trying to say?
Well, the income you receive from renting your property is reportable on your tax return, and then expenses for ownership or maintaining the property are deductible. This would include things like your mortgage interest, your property taxes, insurance, utilities, repairs, maintenance, those kind of things. So the income goes in, the deductions come out. You also get to write off the cost of the property through a depreciation deduction. And for residential real estate, you're going to write off the cost of that property over a 27.5-year period.
A residential rental property compared to what?
A commercial rental
commercial
property.
building, like a warehouse.
Right. Commercial buildings you're going to write off over 39 years. So there's a difference in the timing and how you're going to write your depreciation off of the building.
And what do you do? Take X amount of dollars divided by 27, and you said 27 and a half, correct?
Right, and that's pretty much what happens on real property. It is a straight line depreciation, so it's pretty much going to be the same year after year after year. The thing that you're going to find, though, that in a lot of cases during the first years of a mortgage, you're mainly paying interest. You're paying very little principal in those first 5, 7, even up to 10 years. Your depreciation deduction is going to be straight line. So we find in a lot of cases our clients come up with a paper loss during those first years of owning a rental property. For example, let's say that you bought a rental property and you paid $250,000 for that property. Let's say the land value of that property was $50,000.
Why is that important?
Because you can't depreciate the land value, so you have to subtract that out.
Oh, but now does that stay constant throughout the 27 and a half years? Because land goes up as well as homes.
Right. There's no depreciation for the land, but your basis in that land just stays
number's
constant.
locked in.
Mm-hmm.
Okay, that's good to know.
So what ends up happening in those first years, in this example, your depreciation will be a little over $7,200 a year. But in those first years of a mortgage, I kind of ran a scenario, and the interest portion was about $4,000, depending on your interest rate. So you may be only paying $4,000 in principal payments, but your deduction for the cost of the property is going to be $7,200. So right there, you have $3,200 more in deduction than you actually spent. So sometimes there'll be a paper loss, and that can be advantageous for people who want to be able to take some deduction against that rental property.
Anytime you can get a deduction, it's important. You've taught me that.
Yeah, and that's very true. If the property has a profit, then it's going to be taxed at ordinary income rates. But if for some reason there is a loss for the year, then the rules change a little bit.
And I was about to ask you, we're depreciating the property. What happens when I sell it, though?
When you sell a property and you sell it for a gain, then you have to recapture that depreciation at ordinary income rates.
That sounds scary.
Well, it's not necessarily scary, but you just have to know that exists. Any gain you have over and above the depreciation that you've taken, then if you've held the property long term, that's taxed at capital gains rates. So when you sell a property, part of it's going to be taxed at one rate, part of it may be taxed at another.
And that's why we have you, a tax professional.
Right, to be able to help you determine that.
That's not common knowledge.
It's not common knowledge. So yeah, there is a difference in the rates. The depreciation recapture will max out at 25% though. So kind of keep that in mind as well.
I got you. With rental property, you can sell property and basically do an exchange to where you're not facing tax liability, correct?
Right. There is something called a 1031 exchange, which is also known as a like-kind exchange, where if you sell an investment property and you are going to purchase another investment property, or in some cases investment properties, as long as what you're buying is more than the value of what you're selling, then you've got the opportunity there to roll those gains into the new property and defer paying taxes.
But now there's a very important catch with the 1031 exchange, 1031, correct?
There is a catch.
Very, very important catch, and I know people this is bitten. Something about money in escrow and not in your hand. Right.
You cannot take possession of the funds at closing. So if you sell your first property, that closing proceeds has to be held by...
You got a $100,000 check.
Right. That has to be held by a third party.
Your attorney, probably.
Your attorney, or there's companies that actually do that. They'll be your third party intermediary in the transaction. Then you have 45 days to identify the property that you want to buy as your replacement property, and up to 180 days to actually close on that property. But you cannot take possession of the money.
Because if you do,
then it becomes taxable.
You pay taxes on it.
As a matter of fact, I have a client that I'm working on her tax return right now that had done a like-kind exchange before when she was married. Well, she sold a property this year and bought another one, and she thought she had done a like-kind exchange, but unfortunately she took possession of the closing proceeds, so she will have to pay tax on that money.
I know some people that happened to, and it's horrible because they got the wrong information or they didn't get the right information.
So, yeah.
Someone should have been saying, hey, don't do that.
Right. Well, and they should have talked to their accountant and gotten some information on exactly how this was going to work. And they would have known, the steps that they had to take to make it qualify under that 1031 exchange treatment.
Now, real quick, not to dig deep into this, if you're flipping houses, though, all this is different.
All of it's different. What we're talking about is if you have long-term investment property, rental property. If you are buying a property with the intent to resell, then that is taxed at ordinary income rates. There's no depreciation. Everything's taxed at ordinary income rates. It's kind of like being a computer salesman. You're buying and selling computers.
Yeah, you won't have it long enough to depreciate it, in theory.
Well, and you can't depreciate it anyway. It's considered inventory.
I got you.
So you're buying inventory, you're selling inventory. Most times, you're going to do that within a year anyway.
It just happens to be a house.
But yeah, but you're in the business of selling houses, and in that case, it's like any other business. You're going to pay taxes at ordinary income rates, just the same as you would if you were selling computers or any other item. A lot of times we find that because of the self-employment tax that comes into play, if you are going to flip properties, you may want to look at setting up an S corporation and try to.
So you've got different tax rules, obviously, for your own home, your residential, your principal residence.
Mm-hmm.
You've got different tax rules if you're getting investment,
Right.
and then more rules if you're flipping.
Exactly. There's different rules depending on the
Wow.
situation.
Now I know why I'm a radio host,
It's a lot to keep up with.
because I'm not doing any of that. Wow. So, okay, we've established there's differences. So talk about some of these differences. Do you hire a management company? Do you do it yourself? You talked about getting that call the air conditioning's out. How is all this taxed? How do you keep track of all this stuff?
Well, you want to keep a set of books, obviously, just like you would any other business where you're keeping good records. As far as the issues with tenants calling with issues, I definitely want to say that you want to consider having a good Rolodex of people that you can call.
I can imagine.
To be able to help you with those things. But it's back to the tax treatment. We talked about the fact if you have a gain on the rental property, it's taxed at ordinary income rates. And if you have a loss, it does get a little bit trickier. Because real estate is considered a passive activity by the IRS, there's something called passive activity rules that come into play.
Of course there is.
Of course there is.
There's a rule for everything.
Exactly. And then for that rule, there's usually 10 exceptions. But
Wow.
one of three things is going to happen if you have a loss on a rental
For the
property.
passive activity rule.
Yeah, one of three things. So number one, if you have other passive income, you can take that loss against other passive income. So let's say you had a rental property that you had a gain on, that you had a profit on. You've got one that you've got a loss on. Let's say the one with the profit's $3,000, the one with the loss is $1,000. You can net those together and only pay tax on $2,000.
It's a group effort, basically.
Pretty much. So you can take passive losses against other passive income. Now, the second thing that might happen is if you actively participate in the rental property, which basically means that you're making management decisions. You're deciding, you're approving tenants, you're arranging for services such as repairs. You're actively involved in the rental property.
What if you own what if you employ a management company?
Well, you can still have active participation even if you have a management company. There again, as long as you are approving tenants and you're doing
Or kicking them out?
Yeah, or
the sheriff over there.
The
said, "Get out
management
of
company
here."
comes to you and says, "Okay, we need
There's
to put
that
in
temperament again.
a new air conditioner. It's going to cost $6,000. Are we okay to schedule someone?" Then you're actively managing those
I got you.
subcontractors. But if you actively participate, you may be able to qualify to deduct up to $25,000 in rental losses each year. There again, there's an AGI limit that comes into play. So if your adjusted gross income is more than $100,000 up to $150,000, you may lose that. But there is that potential there to be able to deduct that against other income. So if you have W-2 income, if you have W-2 income and you actively participate with a loss, you may be able to deduct that loss on your tax return against that W-2 income.
You can take it. You just said that you can take it against a W-2 income.
You could.
Well, that's important to know.
Now, and then the third thing that might happen if you don't have other passive income, or you don't qualify because of the income limits, or you don't actively participate, then your losses are suspended, and they just basically roll forward into a year that you have passive income that you can take it against, or a year where your income's low enough to where you can deduct it, or if you sell the property, you can take those losses against the gain on the sale. So you're not going to lose the tax benefit of those losses. They're just not going to help you right now. They're going to roll forward. So eventually you will get to use those losses against income that you have from the sale.
That whole active participation, that to me, that's very interesting.
Yeah.
What people consider.
And there's also something that we won't get into today called material participation, which is totally different as well.
Imagine that.
Yeah, different rules.
Because there's laws saying different things: development, construction, rental. It's all different.
Right, and it is. Now, there's also one other possible loophole that might get you out of those passive activity loss rules.
Loopholes can be so exciting.
Oh, they can be. And that is if you qualify as a real estate professional.
Ah.
Now, if you are
One of those people.
Yeah, one of those people. If you're qualified as a real estate professional, then you must perform more than half of your personal services, which basically means what you do for work, your W-2 job, or if you own a business, in the area of a real property trade or business in which you materially participate in, there's that word we talked about before, and that you spend at least 750 hours per year participating in a real estate business. So that could be anything from a real estate developer, someone who's in the construction business, someone who does rental property management, leasing, or real estate brokers.
So it's 15 hours a week, basically.
Yeah. Basically what you're looking at there.
2 days a week.
And as long as you do that, then you may have the ability to deduct those losses against other income as well. And if your rental activity rises to the level of a trade or business, you may also be able to take advantage of some of the business strategies that we've talked about here on the show in the past, such as hiring your child to work in your real estate business, hiring your spouse and being able to set up a medical reimbursement plan, taking in home office deductions, some of the other things that businesses get to take advantage of, you may be able to as well for your rental property business.
Awesome. That's a lot of good information.
And there are guidelines that have to be met for each one of these things, so you definitely want to make sure you have all of the information. It's a lot more than we could obviously cover in our show today, but definitely something to think about if you're looking into getting into rental property.
Ladies and gentlemen, give Jacqueline a call. Go to the website. But before we give them that information, you've got a trade show coming up in a couple weeks.
I do. We are going to do the 85 North Realtor Board Trade Show in
85 North, Jackson County, Banks County.
Jackson County.
Yonder.
The big city of Jefferson.
Maysville.
Big city of
You
Jefferson.
know, I got friends in Maysville.
I
We
know
don't
you
always.
do.
Well, I guess we do always talk about that. But anyway.
Yeah, we've got that coming up on October 16th, the day after
Yeah,
Tax Day.
in a couple weeks. Am I invited?
You are invited.
Nice. Anyone comes to the table, says you heard us on Business Radio X, I will buy you a drink later.
Okay.
I usually buy them drinks anyway. But
Okay.
Don't tell them I said that. Jacqueline, how do they get a hold of you?
You can give our office a call. The telephone number is 678-866-4047, or you can visit our website, which is bottomlinega, as in Georgia, bottomlinega.com.
Any other pearls of wisdom before we go to break?
Well, the only other thing I would say is if you're going to be active in a real estate business, then there's three things that you need. Yes, there's three things that you need to make sure that you have. First of all, you need a good accountant, because as you can see, the rules are different depending on what you're doing, so you need to know how all of this works. The second thing you need is a good real estate agent. And Sandy and I know one of those that we could help you out
They
with.
actually make good real estate agents?
If you need a good real estate agent, but you need somebody that's out there keeping an eye out for
Or
properties.
become one yourself.
Well, that's true.
That's why people do that.
But if you got a good real estate agent, they're keeping an eye out.
We got the accountant, we got the real estate agent.
Right. They're keeping an eye out for properties for you. And then the third thing that you want to have is a good relationship with a mortgage person.
Mortgage person.
Because once those properties
Well,
come
was
up,
that a segue or what?
I love it.
You
I
need-
love
Telling
it.
you.
you need to have that good
We
relationship.
worked on that in the car all the way down here. It was awesome.
So you can get that financing in place to be able to buy that property. So those three things are something you definitely need to have.
We're going to be hearing from Miss Sandy Hill in just a moment. Ladies and gentlemen, we're going to take a quick break, and hopefully the ladies will not go anywhere running and screaming. We'll be right back with you. Are you paying too much in taxes? Who isn't? Taxes are the highest expense small businesses face. Maximize your return on investment. Reduce your tax bill. Tax planning and tax resolution strategies, the art of keeping more money you've worked hard for. Schedule your free tax planning consultation by visiting www.bottomlinetaxsolutions.com. That's bottomlinetaxsolutions.com. My small business had done well and thought I'd paid my taxes. Then I got a letter from the IRS. I didn't know what to do. So I called Bottom Line Tax Solutions. They understood exactly what I was going through. Bottom Line worked with me and for me. They turned a horrible time into a manageable one. Now, I'm in a payment plan I can afford, and they were able to get my penalties reduced. Schedule your free tax planning consultation by visiting bottomlinetaxsolutions.com. And ladies and gentlemen, we are back. Jacqueline, thank you so much for a very entertaining first segment.
You are very welcome.
Now, ladies and gentlemen, what you've all been waiting for. Mrs. Sandy Hill is with us from Fairway Independent Mortgage. Hello, Sandy.
Hi, Tom. It's great to be here.
You look excited.
I am so excited.
This is going to be fun.
It is going to be awesome. It's my first radio experience.
Are you serious?
Serious.
Wow. Usually you're on the other side of the speakers. Now there's a horrible joke somewhere in there I'm not going to make.
Okay.
Tell the folks about yourself, a little bit about yourself.
Okay, so I am from California. My
Really?
husband and I moved here about 26 years ago. We absolutely love Gwinnett County.
Do you? Well,
Yeah,
good.
we do.
The Southeast in general is an amazing place.
It is. It's my roots. I grew up in Clearwater, Florida.
Okay, well, there you go.
Yeah. But I have actually been in the mortgage industry about 34 years.
Since you were, what, 3?
I really like you, Tom.
You know,
Thank
I
you
try.
very much.
I got to keep the guest happy. It keeps me coming back.
So I have basically been in every role in the mortgage industry and the loan processing. So I have settled upon, and my highest and best use is being the loan officer, helping direct clients so that they know the best alternative when they want to buy a home or if they want to refinance. And I basically have to marry their wish list, Tom, which is their objective, with their qualifications. And their qualifications is going to take into account their credit, their income, their assets, and as Jackie mentioned a little bit earlier, their reserves. Particularly important with a rental property.
I can imagine. So I'm going to assume, I hate assuming, but buying rental property is good for the investment portfolio, or no one would do it.
Absolutely. It's a great way to diversify. So when you're buying an investment property, you truly are gaining equity in 2 different ways, adding to your asset pool. Number 1, you have a property in Gwinnett. Just over the last year, I would say it's typical 3 to 10% real estate appreciation. So you're gaining equity. Secondly, you have your monthly income, right? That renter's paying you every month. So you're putting cash in your pocket. You have both then your asset, your real estate value going up, giving you an equity spread, as well as having monthly income. So it truly is a great investment.
Well, I'm sold. So where do I start? Tell me, how do I start this?
So you basically give me a call.
What do I investigate? I just call you and say, find me houses.
Yes, you call and you give me your wish list. You give me your objective that, hey, Sandy, I'd like to see about buying an investment property. And I'm going to start you off by getting a snapshot of what your qualifications are. We're going to want to know, again, pull a credit report on you. You're going to fill an online app for me. Going to investigate your income, your debts. And basically, I'm going to be looking at your income versus your debt ratio. That's called your debt ratios. On an investment property, Tom, it's a little bit more stringent than if you were buying an owner.
I knew you were going to say that.
Yeah, just kind of how it works.
So what makes a property a rental, or what makes it an investment? I realize your principal residence, that's easy. But
Right.
what makes it a rental? What makes it an investment? What makes it any of that?
Good question. So if you are renting it out greater than 14 days a year, it becomes a rental
Only
property.
14.
Only 14.
That would go by quick.
It would.
Wow.
So then we get into a lot of times the variable where people want to buy a second home versus an investment property, and we have to watch those guidelines with rental very closely.
I got you. When it comes to finance, it comes to getting a loan. I already know the answer to this, but explain it. There's got to be differences for getting that financing for that rental property versus the house you're going to live in, or maybe even your second home. There's got to be differences in getting that financing.
You're right. So a rental property for the lender is absolutely a higher risk. If you have somebody living in their home and they have a life event such as a divorce, a job loss, something happened in their life that's critical, if they have an owner-occupied home versus an investment property, which one are they going to pay first?
Right.
Yeah.
I imagine your rates are going to be higher, too, for investment. More risk.
So we're going to be a little bit more stringent with the number one defining difference is down payment. So on an owner-occupied home, there are programs available with VA, USDA, first-time homebuyer programs with no money down. That's great.
Wow.
But not on an investment property.
Right.
investment property, they're looking for a minimum of 15% down. But if
Okay.
you go to 20 or 25, you're going to get a better rate.
Of course.
And as you just mentioned, the interest rate when we deal with an investment property versus owner occupied, about 0.5% to 3/4 differential. And it's going to be based upon credit score and whether you have your assets in line with your reserves.
If you run across anything odd, anything different that sticks out in your mind, there's got to be a good story. You've been doing this for a few weeks, few months. I want the dirt. I want to know how this stuff works. What am I going to run into? There's got to be a good story somewhere.
So I have a client, let me share with you, that started with me about 15 years ago.
This
and
is the dirt I want. This is
There
good.
you go.
This is good.
There you go. And they started with their first investment property, and they started parlaying about every year. They would buy an investment property, and they basically got out of their regular jobs, their 9-to-5s, and they went full-time into property and being owner of a property. They ended up with about 13 houses.
Nice.
And then as they started approaching retirement, then they wanted to go ahead and start selling those properties off, and they used the equity
Right.
that they had gained to be able to pay off another home, and they were able to go ahead and now they're currently sitting with about 5 properties, but they're all mortgage free, debt free, so
Nice.
everything they have is income to them.
What was the time length, did you say?
I would say that was over about a 10 to 15 year time frame.
Wow, that's not long at all.
Nope.
That's amazing.
Nope.
Well, I'm sure. I know we're not real estate agents, but location. You mentioned Gwinnett County.
Yes.
Very good.
Well, I mentioned having a good real estate agent. That's something you want a real estate agent available for. They're going to know where the good rental neighborhoods are. They're
Right.
going to know where you're going to be able to get the best rent. They're going to be able to direct you and say, hey, this house is coming up. It would be great for a rental property. So that's why having that real estate agent on your side is important, because when they come, you know how properties are. They come up on the market and they're gone tomorrow. So if you have somebody that already knows you're looking, they see something come up and they can call you and say, hey, this is available. You need to go see it today. That's the way you want it to go.
Wow. Now I think we've scared people off, though. It's more difficult to purchase a rental property, but it's not impossible.
Not
I
impossible
mean,
at all.
they had what, 13? Did you say?
Mm-hmm. 13
Wow, that's
properties.
awesome.
And the rule of thumb is, as Jackie mentioned, go ahead and meet with your mortgage planner so that you can get a strategy in place. The number one key component with any lending, any purchasing today, credit score. Credit score is key. So if we find out that you have a credit score that falls below the benchmark where you need to be with investment property, we can go ahead and get that lined up. There are several tools you can use to be able to get your credit score where we want it.
And I got to believe cash on hand is important.
Cash on hand is huge.
Yeah.
As Jackie mentioned again, when you have those issues, maintenance issues, what happens if your renter doesn't pay? We are
Right.
looking for at least a 3 to 6 month reserve.
Wow.
Yeah.
See, that's important information.
Yep. Yep.
That's
yep.
huge. That's huge. So
That's
you're
good to
diving
know.
into all that.
Exactly.
But at the same time, and I'm sure someone would say it's prying, but and I know you're trying to protect both sides, but if I'm going into this thinking it's all going to be roses, I want someone digging into it to say, hey, Tom, you need a little more here, you need a little more there before you jump off and do this.
Exactly. And the bottom line is the lender doesn't want a borrower to lose their home. And
Right.
yet, again, life happens. People lose their job. They have divorce. Their income's cut in half. So we're basically trying to just put a little bit of a buffer. So
Right.
when one of those events happens, someone can still carry on, make their payments, help out until they get another renter in that property.
But the planning's basically done up front.
Exactly. That's key.
Proactive, not reactive.
We're all about proactive.
Wow. And that, ladies and gentlemen, is why you call upon someone like Sandy Hill to take care of these needs before you get into trouble. I guess a foreclosure notice would be like a nasty gram from the IRS, I would guess.
Pretty much, probably very similar.
Wow. Lovely. Well, such good news we bring the folks. Sandy, how do the folks get a hold of you?
I am at 678-713-3636, and my website is www.sandyhillfairway.com.
sandyhillfairway.com. Did I say that right?
You did.
Nice.
Very.
The best mortgage talk you've ever had.
Well, there you go.
Nice.
Thank you.
When you're ready to come do this full time, just let me know.
Okay.
I'll vacate. You can interview people. It'll be great. You did really well.
Thank you.
I know you were nervous ahead of time.
Thank you.
Is there any other pearls of wisdom you want to share with the folks that I skipped over somehow?
I would just say if you want to get involved, don't be afraid. We've got to take that first snapshot, come in, give me a call. We'll go ahead and if you're not ready now, we will get a strategy in place. That's what it's all
Create
about.
a timeline.
Mm-hmm. Exactly.
Well, that's important. I like that.
Exactly.
Well, ladies, great job. Great job as always. Jacqueline, you want to do this again next month?
I think we shall.
All right. Well, ladies and gentlemen, thank you so much. We will be with you soon. Thank you for sharing your time with us on Business RadioX. Schedule your free tax planning consultation by visiting www.bottomlinetaxsolutions.com. That's bottomlinetaxsolutions.com. And click the link to hear more podcasts like this one. I'm Tom. She's Jacqueline. That's the bottom line.